Okay, let's start chapter 4. Now, we've already learned most of this cycle, the accounting cycle. And in the last chapter, what we did was we started to go ahead and do the adjustments, making all the adjustments needed to be made. Everything that had happened during that time period, we need to make sure that we took account for those things, given accounting. And in this chapter, we're going to complete the accounting cycle. So we've taken the adjustment, we've gone and we've made the adjusted trial balance. And now we're going to go on and we make the reports. And now we're going to close out the cycle, pretty much redo the cycle so we can start anew. So this is what we're going to be covering in this chapter for completing the accounting cycle. Okay, our learning objectives in this chapter 4.1, we're going to prepare the financial statements, including the classified balance sheet. Now, we're going to talk about how the classified balance sheet is different than our old general balance sheet and how we classify different sections of the balance sheet. We're going to explain the purpose of journalized and post closing entries. And we're going to prepare the post closing trial balance. And we're going to describe the accounting cycle. And then we're going to use the current ratio to evaluate business performance. And then we're going to use the worksheet to prepare financial statements, Appendix 4A. So this is 4.6 is just a continuance of the last chapter's worksheet and how we are now continuing that worksheet to create financial statements. And so you see that we have the income statement on there, and you also see that we have the balance sheet on there, but we do not have a statement of retained earnings. So we're going to talk about how that differs than what we really do, what we actually put out in statements, than what is on that worksheet. So, 4.1, we're going to prepare the financial statements, including a classified balance sheet. So, how do we prepare the financial statements? The financial statements. The first one we covered is the income statement, right? Their income statement reports revenues and expenses and calculates net income and net loss for the period. This is what tells us if we're having a profit, if we're losing money, if we're having a loss. This is where we compare all the revenue. So, revenue, as we always mention, does not equal profits, but revenues minus expenses, now we have profits, right? Now we can see what our net income is, which pretty much is our profits for the company. Statement of retained earnings shows how retained earnings change during the period due to net income or net loss and dividends. So, if you've had intro to accounting or if you have a small business, this is the owner's equity account, right? So, retained earnings or the profits that we keep to put back into the company to run our day to day expenses and to prepare the company to make big purchases and other things. So, this is the money that we leave inside the company to keep the company rolling. The balance sheet reports assets, liabilities, and stockholders' equity as of the last day of the period. So this is goes back to the accounting equation. Assets equals liabilities plus stockholders' equity. So when we go back to the assets, what are assets? Things that we use to create more revenues within the company. And those things are either owned or owed. So if they're owned, they're stockholders' equity or part of the company, stockholders' equity, or their liabilities, right? So in a corporation, the owners are the stockholders and they own shares. And shareholders or stockholders' equity, that's who owns that. Liabilities are things that we've taken out, either loans or we've taken out some kind of credit to possess those assets. So all of our assets are either owned or owed to somebody. So, how do we prepare the financial statements? The financial statements are prepared from the adjusted trial balance. So, in the last section, we talked about all the adjustments we need to make: prepaid rent that we've used, accounts payable that we paid off, accounts receivable that we've received, all these payables and receivables that we have accumulated throughout the time period, and all the changes that have been made during that time period. These are the adjustments we make. And so, off of that, we create this adjusted trial balance, which we have broken down into assets and liabilities. So, that first part is going to be our balance sheet. All the assets and liabilities are our balance sheet. We should probably start with the bottom because when we do our reports, the first report we want to generate is the income statement. Why is that? Because the income statement is going to give us our revenue minus our expenses, and that's going to generate our net income or net loss. And that is what we're going to carry over to our statement of retained earnings. And so this next section is our statement of retained earnings. This is what we're going to put onto our statement of retained earnings, dividends and service revenue, and we'll also have to take into account our net income. And then the last statement we're going to prepare is our balance sheet accounts. Now, that's because our statement, our retained earnings, is then going to be transferred over as an asset over to our, or is going to be transferred over to our balance sheet, not as an asset, but as owner's equity. And so this will give us our new owner's equity and it transfers over to our balance sheet. So it's separated into different categories, but I would like you to think of the bottom as the first, the second the statement is going to be the statement of retained earnings, and the third statement is the balance sheet. And they have them numbered one, two, three. So the financial statements relate to each other, right? Net income or net loss from the income statement flows into the statement of retained earnings. So depending on if we had net income or we had net loss, that is going to be passed on to the ownership. And ownership is either going to create, it's going to either create more ownership, more profits, or more create more income for the retained earnings, or it's going to lower the retained earnings. Ending retained earnings from the statement of retained earnings flows into the balance sheet. That's what tells us what our owner's equity is, right? So we get our owner's equity, our new owner's equity based on how much we've either made in net profit or net loss, and then transfer that over to our balance sheet to show how much we have in owner's equity. So here's our income statement. First thing we're going to see is our revenue. And our revenue is then going to be in the prior chapters. The statements do not have credit debit. So when we look at this, this is why a trial balance is not an actual report. Trial balance has credits and debits. Statements do not have credits and debits. They only have totals. So the 17,500 is a total, and then we have subtotals that are indented. So here in expenses, this is a subtotal because we're calculating it and adding all of the amounts of all of our expenses to get our total expense, which is our total, which goes out to the right. So we take our revenue minus our total expenses that gives us our net income. So luckily in this company, Smart Touch, we've actually earned net income. We've actually made a profit. So we're actually a profitable company. Then that net income is transferred over to our statement of retained earnings. So since this is a new company, our retained earnings has $0 in it to begin with. And then we have our net income for the next 2 months. That gives us 8,500. We have 8,550, and we always have to take away our dividends. These are payments paid out to the stockholders. So dividends are paid out to the owners. This is like taking a payment to the owners, or if the owner, if it's like a majority owner, it's a small company, but it is a corporation with stockholders, then that payment is mostly paid. Then the owners can say, hey, I'm going to take out a paycheck or I'm going to take out a payment, and that is paying themselves, right? And then the rest of that is going to retained earnings to go back into the company and be used to run the company, to keep the company producing more. And this is where it's going to be in our owner's equity. So if we take that out, we see that we have our assets on the left side, then we have our liabilities, things that we owe. And then under stockholders' equity, we have our common stock, things that are paid out into the company. So we have common stock, and then we have retained earnings. And this gives us our total stockholders' equity, and our total liabilities and stockholders' equity should equal our assets. So we go back to the accounting statement, assets equals liabilities plus stockholders' equity. If you want to make sure that your balance sheet is correct, you have to make sure that this equation is in check. It's balanced. Assets has to equal liabilities plus stockholders' equity. If you do not get that equal, if you do not get them to equal each other, there is a mistake somewhere, right? There's an error. There's somewhere you have to find to make these equal each other out. So now we're going to take this a step further. And instead of just having a general balance sheet, we're going to have a classified balance sheet. This places each asset and each liability into specific categories. So we're going to break down the balance sheet, breaking down into the assets and liabilities. Assets are shown in order of liquidity. What does that mean? Liquidity measures how quickly and easily an account can be converted to cash. How easily can I convert this over to cash? How easily is this can be turned into something that's interchangeable that I can use as currency, right? And of course, what is the number one most liquid thing that we have? Cash, right? So cash is going to be and we're going to talk about this, is current and long-term assets, right? And then liabilities, right? Liabilities are classified as current, due within 1 year, or long-term, due after 1 year. You can't have something, think about it, it has to be due within a year. So you can have times where there's long-term liabilities, right, that do turn into and we'll talk about this later, turn into current liabilities because they're due within that year. Current assets would be converted into cash, sold, or used up during the next 12 months. So if an asset is going to last longer than 12 months or within the business operating cycle, the cycle is longer than a year. Usually they do not go longer than a year. Most things are broken down. If they're not within the calendar year, they're within a fiscal year. So if your operating cycle is usually a year, no longer than a year most times. But if it is, then that would be, if it does fall within that time period, say you have the rare occurrence where you have something that's a business cycle of 18 months for some particular reason. If that asset will be used up within that 18 months, then it is a current asset. The operating cycle is the time span when cash is used to acquire goods and services. These goods and services are sold to customers. The business collects cash from the customers. So during this time period, say maybe you're a farmer and it takes you longer than a year to collect and do all these things, or maybe you're in the wine business, right? And it takes time to produce the wine. And so your first business cycle may take 5 years or 3 years to produce your first bottles, to sell them, and to then collect the revenues, right? So anything within that certain cycle, but let's just keep it simple and we'll just say to 12 months. Anything a year or less is going to be a current asset. Anything that you're going to be able to spend or use up within a year or less. So this is where we separate within long-term assets, which usually fall under property, plant, and equipment. So usually property, plant, and equipment items are going to be our long-term assets. So all of these assets that will not be converted to cash are used up within the business operating cycle or 1 year, whichever is greater. Long term investments, right? So most things are going to be property, plant, and equipment, but we do have long term investments as well. An investment or bond or stock that the company intends to hold for longer than 1 year. As we know, companies invest in other companies, or they invest in municipalities, they invest in different bonds, and they themselves can own investments. If these investments are for long term, if you are not intending on selling these investments or cashing out on these investments, like if it's a 5 year bond, then that's a long term investment. Property, plant, and equipment is what we're going to be mostly using. These are long lived, tangible assets used in operation of a business. And just like in the name, this can be a building, equipment, any kind of plant that you use, anything that's going to be long term. Vehicles, that is going to be under property, plant, and equipment. Intangible assets are assets with no physical form. They're valued because they're special because of the special rights carried. This can be patents, this can be copyrights, trademarks, things that hold value but are not tangible. We can't hold these, right? Maybe you can hold a patent in your hand, the paper itself, but the patent is greater than that, right? The patent is something that is an idea that you've constructed and that you own, and or a some kind of technology that you've invented that you owned, and so that can give you benefits over a longer period of time. That can be a long-term asset. Current liabilities must be paid either with cash or with goods and services within 1 year or within the entity's operating cycle. So, examples of current liabilities, we're looking at accounts payable. Usually, those are only 30 days. Salaries payable are most of the time less than 30 days. Usually, the longest time period you'll have for salaries payable is 15 days, or a day for even a month time period. And then you have unearned revenue, right? So, unearned revenue can be longer than 30 days. It can be pretty long, especially say you do a year. It could be right at a year, right? Say somebody does a subscription for a year, that's unearned revenue. It can be a current liability as you were to perform these tasks within that year period. So long as it falls in a year time period, it will be a current liability. Long term liabilities are liabilities that do not need to be paid within 1 year or within the operating cycle. These things can be notes payable, mortgages, long term bonds that you've issued. These are all long term liabilities. These are going to be longer than a year and will take a longer time period to pay off. Stockholders' equity represents the stockholder's claim to the assets of the business, reflects the stockholder's contributions through common stock. As we raise equity, as we raise funds in corporations and in businesses, and you use stocks, this is how you're selling. You're not going into debt, but you are taking on more owners into the business, right? So when you're investing, you're actually becoming a business owner, right? You're owning part of the corporation. Some of these huge corporations, the largest one is Walmart. You can go into Amazon, you can buy Tesla, you can buy any Kroger, any of these public companies, you name them, right? Name the company. If it's a public corporation, you can buy stock and enter into it, and you are part of the stockholder, right? But what you're basically doing is giving money to the company that they can use to build the company and to use to run day to day business or to build up capital. And in return, you get a share of the company, you get to share in the profits. It represents the amount of assets left over after the corporation has paid its liabilities. So, one thing you need to know as a stockholder is that you are last on the totem pole when it comes to receiving funds. So, if any corporation ever goes bankrupt, the last people to get paid are the stockholders. It's common stockholders are the last ones to get paid. All creditors, depending on how much they owe and who and what and all these other things that come into play, are lined up before you. So when it comes to distributing the assets and to divvying up the company, stockholders usually are left holding the bag. That's usually why if you invest in something, you lose a lot of money. It's usually because you were the last ones to get paid out when a company fails. And if there's anything left, then you get your 2 cents or whatever's left. Classified balance sheet, as we can see in this example, we break down our current assets. So we have cash, accounts receivable. These are all within a year. Supplies we're going to use. Prepaid rent. Now, this prepaid rent, we know that we're going to use it within the year, so it's a current asset. And then we have property, plant, and equipment. And this balance sheet, we're not seeing any long-term investments, so we just use our property, plant, and equipment. And then that gives us our total assets. And like I said, indention for subtotaling, and then we even have more indention for buildings and accumulated depreciation for subtotaling to get our subtotal again, and then to get our totals. And so we get our total assets on top. Liabilities, we're broken down into current liabilities and long term liabilities. And then we have our total liabilities and stockholders' equity. We have common stock, retained earnings, which gives us our total stockholders' equity. And then we have a total liabilities and stockholders' equity, which should then total our assets, which is the same total we had before in the general balance sheet. But only this way we're breaking down the balance sheet to show be more detailed into what is current and what is long term assets and liabilities. This helps people that are looking at a firm's balance sheet and looking into their financials to know if a firm is in a lot of debt, how much of that debt is due now? And this one of the things we're going to look at the end of the class is one of the ratios to show or current ratios. The current ratio to show if businesses, when creditors or investors are looking at business, they'll look at the current ratio to see how business is doing, and if for any reason their debts are being called upon, how quickly can they pay the debts that they owe within that 1 year, and how many assets do they have available to make these payments. Okay, let's go on to objective 4.2. We're going to explain the purpose of journalize and post closing entries. So at the end of the year, and let's go ahead and talk about this. What is the closing process and how do we close accounts? So the closing process zeroes out all revenue and expense accounts in order to measure each period's net income separately from the other periods. We do not want to take and carry forward these accounts, as we treat these accounts as temporary accounts, right? And the way we conclude that is these accounts will bleed into or transfer over into other accounts, right? So revenue and expenses will then carry on and give us our net income, which then transfers over into our retained earnings and eventually ends up in retained earnings. So at the end of the year, the whole process is to clear out all these temporary accounts, which are revenues, expenses, into an account called income summary. And then we also need to take out our dividends and transfer that over into our retained earnings as well. And then that's going to go into our permanent accounts: assets, liabilities, common stock, and retained earning accounts. These are accounts that keep on collecting and getting transferred from year to year. Temporary accounts, we close those out at the accounting period. So when we close out those accounts, we start over anew. And this is usually done on a yearly basis. So or you can do it on however you want on the accounting period, but most of the time we do this on the time period Say we do it on a yearly, at the end of the year, we close out all these temporary accounts. That way, when we start near the year anew, we know how much we collect in revenue for that year. And as the years keep on continuing, we know how much we're collecting throughout that period. And we're not actually adding things from the prior year. We do in the end when we transfer those temporary accounts over to our permanent accounts, and we can see how much our retained earnings has been growing, how much our assets have been growing, how much common stock, how much liabilities we've been accumulating. All these things will accumulate at the end of the year as permanent accounts, but we eliminate those temporary accounts and start over. So, what we need to do to eliminate or to remove these temporary accounts is we have to create closing entries. So, closing entries transfers the amounts in our revenue, expenses, and dividend accounts over to retained earnings. And we, except for dividends, like revenues and expenses, they don't just transfer straight into retained earnings. We don't just transfer those amounts straight to retained earnings. We have a kind of a holding place for those. And that holding place is the account income summary. And now this is a temporary account that summarizes net income or net loss for the period. So what we do is how we combine our revenues and expenses and we transfer them over to this temporary account income summary to then calculate our net income or our net loss, which then we transfer over to retained earnings. Now, dividends, that account will close out and go straight to retained earnings. Revenues and expenses do not do this. They go to a holding account, which then determines, that calculates our net income or net loss, and then that is transferred over into our retained earnings account. So here, this is how we do it. So expenses have a normal debit account balance, right? So what we do is we add up all of our expenses and input a credit account, a credit balance equal total to the debit account to make this account zero out. So let's say we have debits of and expenses. Let's say we have $8,000 of expenses. We would input a $8,000 credit into this. We would create a journal entry that would have an $8,000 credit, and we would credit expenses, which would zero out this account, and then we would debit income summary. And in essence, we are transferring over our expenses into income summary. We do the same thing with revenues. Revenues have a credit balance. We would then create a journal entry that would create a debit of the amount of that we have in revenues to zero out this account, and then we're essentially moving over this debit into our income summary. Then this ledger account would then be totaled, and then we would get our net income. And then our net income, in this scenario, we have net income. If we had a net loss, it would be a debit amount. But here we have net income as a credit amount. And this credit then would be transferred over to retained earnings. To do that, we create a journal entry where we create a debit amount equal to our net income, which zeroes out our income summary. And then we transfer that credit amount. In that journal entry, we would enter a credit amount for retained earnings, which then transfers that amount over to retained earnings. So this is a multi-step process closing out the expense and revenue accounts. We have to first close them out into income summary, and then we need to close out income summary into retained earnings. As far as dividends, we just close out dividends straight into retained earnings. So dividends are a debit balance. We credit dividends. We create a journal entry where we credit dividends, the amount of their balance, to then closes out and zeroes out the dividend account. And then that debit is then in that journal entry, we debit retained earnings, which in essence transfers that amount to retained earnings. And then we are able to calculate our new ending balance, which is our ending retained earnings. And then that is transferred over into the balance sheet. So closing temporary accounts. Let's do this step by step. First, make the revenue accounts equal to zero via the income summary. So Smart Touch Learning has $17,500 credit balance in service revenue. The closing entry would be, so this is the journal entry that we're going to enter. We are going to credit our debit service revenue, which has a credit balance. By putting that debit, we zero out that account. And then when, in essence, we're making that credit, we're transferring it over into income summary. So we credit income summary, And this is to close out the revenue account. And as you can see, as we do this, we zero out the service revenue and we transfer that 17,500 into our income summary. Now, that's only half of the equation. Now we need to do our expenses. So we make expense accounts equal to zero via income summary account. Now, when we do this journal entry, we're going to remember there's going to be multiple expense accounts. So we'll see this on the next slide, but there's going to be multiple expense accounts. You'll need to close out each of these accounts in the ledger one by one. So Smart Touch Learning has a $3,000 debit balance in rent expense accounts. It will be closed with the credit rent expense. So we start off, we'll do a credit to rent expense, and then we'll need to credit all the other expense accounts as well. So this creates a compound closing entry. Each individual expense account is credited and income summary account is debited for the total amount. So our first entry is going to be our debit, right? Because we're transferring all these debit expense accounts over to income summary. And we are closing out each one of these expense accounts by inputting a debit for their totals. So we can see as you go through this and you're doing it through the ledger, you're going to have to enter that amount for each one of the ledger accounts to close them out and zero them out. But then when you create the journal entry, it's going to be a compound journal entry with income summary being the first entry as the debit of the total amount of each account of the total of all the accounts, and then listing each one of the accounts, expense accounts that you're closing and inputting a credit amount for each one of those accounts to zero them out. So the income summary T account after closing revenues and expenses. So we have now income summary. So this is something you're going to have to calculate on the side, and you'll create a ledger account for income summary. And on one side, we have our debit, which is all of our expenses. And on the other side, we have a credit, which is all of our revenues. We then those amounts, combine and total them. And now we can see that we have an $8,550 balance, credit balance, which means we had a net profit, our net income. And that net income is then going to be transferred over to our retained earnings. So we make the income summary account equal to zero via the retained earnings account. This is very similar to what we did with the expense and revenue accounts. So Smart Touch Learning, 8,550 credit balance in the income summary account will be closed to retained earnings. So we know we have an $8,550 balance, credit balance. We are then going to close that amount by entering a debit of 8,550, and then we're going to then transfer that amount, the credit, over to retained earnings at 8,550. This is going to give us a zero amount for our income summary and give us now an $8,550 credit balance in our retained earnings. And then below you can see the journal entry. Income summary, debit, 8,550, which then zeroes out income summary, and retained earnings gets a credit of 8,550. So what we did in that last section was we basically just transferred over our net income as we do when we do our income statement, and then transfer over our net income over to our statement of retained earnings. We practically did that just making journal entries. And by making them journal entries, we are doing this in a permanent way and closing out those accounts. Make the dividends account equal to zero via retained earnings account. So retained earnings, Smart Touch Learning's $5,000 debit balance in the dividends account will be closed to retained earnings. So we have retained earnings and we have dividends. Now we have a debit balance of $5,000 in dividends that we paid out. So we are going to close that out. We're going to enter a credit balance of 5,000, an entry of 5,000 to close that out for our dividends. And then we are going to debit our retained earnings by 5,000, which then gives us a new balance, right? So we have to total and then drop down our remainder, which gives us our new balance. Balance of retained earnings on the balance sheet is 3,550 now. So closing temporary accounts, net income for the period, Smart Touch Learning's $5,000 debit balance in the dividend account will be closed to retained earnings. So as we can see in the prior slide, we made a debit to retained earnings, right? That is transferring over the dividends and we made a credit to dividends to zero them out. And that debit from to retained earnings is transferring over the dividends that we paid out to shareholders. now is being transferred over to retained earnings and gives us a new retained earnings balance. So if a business had net loss, this is just something to be aware of. Not every business is going to have net income. We would hope so, right? Any business that we're a part of, we would hope that we would have net income, right? But sometimes there are periods where we have net losses. The book just wants you to be aware of this. If you were to see this and a problem, that you would not be transferring over. It's not always going to be a transfer over of a credit, right? If we do have a debit loss or a net loss, we will be transferring over a debit amount, right? So if a business had a net loss period, the closing entry to income summary account would be different. Our income summary here, we have a balance of $2,000 debit. That says that we have a net loss of $2,000. We're going to close this account by crediting income summary, and we're going to be debiting retained earnings. So now we're showing retained earnings as a $2,000 loss. And our entry is going to be backward, is going to be different, right? It's going to be opposite of what we had when we had net income. And our retained earnings is now going to be our debit, and our income summary is going to be a credit. By closing out income summary with a credit, and we are transferring over that $2,000 debit to retained earnings. So here's showing all the different. If you get a chance, I would print this slide out or take a picture of this slide so you can see these are all the journal entries that you're going to be doing to close out our temporary accounts. And then this is how it looks on the ledger. So each account having its own, each ledger account having their own balances. And this shows how things are transferred over. Retained earnings is transferred over to income summary. Service revenue is transferred over to income summary. Then we are transferring over we're closing out our income summary and transferring over to, or we can see all of our expenses. So we have rent expenses, we have retained earnings are all being closed out into income summary, and then income summary is being transferred over to service revenue, and then dividends or accounts being closed out, and that is being turned over to retained earnings. So retained service revenue, rent expense coming over to income summary, then being transferred to retained earnings. Dividends just go straight to retained earnings. So now that we have done the closing entries, we're going to prepare the closing trial balance. How do we prepare the post-closing trial balance? The accounting cycle ends with the post-closing trial balance, a list of accounts that their balance is at the end of the period. After journalizing, posting, and closing entries includes only permanent accounts. Okay, so the way you can think about this, the easy way to think about what should be on this post-closing trial balance is what do we end up with when we go through all the steps of doing the income statement, the statement of retained earnings? What then do we end with? The balance sheet. So this should look just like the balance sheet. All permanent accounts are on the balance sheet. So your post closing trial balance should look just like the balance sheet. So when we get this, let's go ahead and look at it. Smart Touch Learning post closing trial balance. And what do we see? Assets, right? Contra assets, and then liabilities, and then retained earnings statement or owner's equity, common stock, and retained earnings. So these are all permanent accounts, which are all on the balance sheet. So you should know your post closing trial balance should have all the accounts that are on the balance sheet. If you see any temporary accounts or any accounts that belong on the income statement, then you know that it's not right, that there's something wrong. We didn't close out all the accounts. If you see an expense on there, if you see any kind of revenue statement, if you see a dividend account or dividends, then we know we didn't do something correctly. We didn't close out everything. So let's go back, and we did this in the last chapter, and let's do it now as we go on and move forward and close out the accounting cycle. So the accounting cycle is the process which companies produce their financial statements for a specific period. And now we're going to do the closing steps of it. Is the steps that follow throughout the time period. It starts at the beginning, asset, liability, and stockholders' equity account balances left over from the preceding periods. So when we first start, we start with the beginning with nothing, right? we should have permanent accounts, and that's all that happens. But we start with a beginning account balances. So if we're taking this on for a new year, we're going to start with all of our permanent account balances. Then we're going to do transactions, right? And we're going to analyze and journal transactions in the journal. So we first start off with all of our permanent accounts that have been transferred from the prior period, and now we're going to journalize all of our transactions. And then from there, we post our journals to our ledger. And then we prepare an unadjusted trial balance. And after we produce that unadjusted trial balance, then we need to go and journalize and post our adjustments, right? So we need to analyze and create all of our adjustments and then post those as journal entries. And then we need to prepare an adjusted trial balance, right? So then we get our trial balance, and then we prepare the financial statements, journalize and post closing entries. So there's two different types of entries. First, we need to do adjusting entries and then post an adjusted trial balance. And then we need to create our closing entries and then post a closing trial balance, post closing trial balance. And then in the middle of that figure, you can see the steps that we take and how we create our reports and in what order we create our reports. Income statement then goes on to the statement of own retained earnings. And then from the statement of retained earnings, we move that on to the balance sheet. So I did mention before the outside people or outside investors and outside parties that are interested in the company will, and even the company itself can analyze how well it's doing with its current assets through the current ratio. So we're going to use the current ratio to evaluate business performance. So the current ratio measures a company's ability to pay its current liabilities with its current assets. So it's pretty much saying, hey, how much do you have in your bank account, and can you pay all your bills for the month with your bank account, with the money in your account? So that's pretty much what it's analyzing, is breaking it down to that. So can a business make all of its, if it had to make all of its current payments, right? All of its current liabilities came due, and it had to make those, pay off all those current liabilities, could it do it with what it has in its current assets? And the way you do this is you take current assets and divide it by current liabilities. A company prefers to have a high current ratio. So if that number was three, that means you had three times the current assets than you do current liabilities. So if something was to arise and you were going to have to pay out all your liabilities, it wouldn't really be a big deal. You could take some kind of hurt or some kind of loss in your business, and you would still be able to make the day to day payments or make all the current liability payments. An increase in current ratio indicates improvement in ability to pay debts. PepsiCo. So the reason companies look at this, because they want to make sure if they're going to lend you money or if they're going to invest in you, to make sure that you're good enough to pay off your debts and that your business is doing well enough to keep on going, right? It's not going to take a small thing's not going to put your company under. So PepsiCo had the following current assets and current liabilities found in the balance sheet. And December 25th, 2020, they had current assets of 21,783 million and current liabilities 26,220 million. And then in 2020, they had 23,101 million in current assets and 23,372 million in current liabilities. So if we look at the current ratio in 2021, they had 0.83. So they were able to pay, if push came to shove, and they had to use their current assets to pay off their current liabilities, they could pay off 83% of their current liabilities. In 2020, they were able to pay off 9.90 or 98% if push came to shove and they had to use that. Now, companies look at that. Most companies would like, and in your book, will go ahead and give you this answer. Most companies or most outsiders would like companies, or companies themselves would like to be at least 1.5. It's kind of having a rainy day fun, which I know is hard today in our current economy. But a lot of people, they like to stay safe. They like to make sure that they can make their bills. So they like to save up, say, enough money so if anything was to happen, they could still make payments on and pay off all their bills for a couple of months, which is kind of hard when a lot of people are living paycheck to paycheck. But companies are analyzed the same way. When they look at your accounts, they want to make sure that if the company is going to lend you money or they're going to invest in you, they want to make sure that you can make your current payments and that you're, like I said, something that's not maybe in this way they look at it. And if something drastic happened, Pepsi may not be able to pay off their debts or may have to go into bankruptcy because of a small thing. And so that's why outsiders look at this number. So let's continue with the worksheet that we looked at in the prior chapter in chapter 3. In chapter 3, we looked at the income state or the first sections where we looked at the unadjusted trial balance, then we looked at our adjusted entries, and then we looked at our adjusted trial balance. In this section, now we're going to carry on into section 5 and we're going to the adjusted trial balance, and from there we're going to move on and create our income statement and our balance sheet. Section 7 determines net income or net loss. The balancing amount for the income statement and the balance sheet sections will be the same amount. So what we're doing is we have our unadjusted trial balance. We created our adjustments and made sure we put in our entries, and then using our entries and transferring over the amounts and taking into consideration our adjustment entries, we now have our adjusted trial balance, which then we can transfer amounts into our income statement, which is going to give us our income statement. First, we're going to transfer over service revenue, our revenue, and our expenses. We get our totals. We will take the difference, and then we can see our net income 8,550. We are going to add it back to whichever side. Now, this could be a net loss. If this was a net loss, the 8,550 would be on the credit side, right? But since it is a net, or since we got net income, we are going to add back on the debit side. That way we total our difference. So we have to add our expenses plus our net income to then equal our revenue. So this way we can see we have net income. Now on our balance sheet, we're going to transfer all the accounts, our assets and our liabilities, but we're going to add two accounts. We're going to add our dividends and our common stock. So it's on our worksheet, it's like we're combining our balance sheet and our statement of retained earnings as well. And then we're going to get our totals there, which we should not equal. They will not equal. Our debits will not equal our credits until we add back our net income. And now you can see our net income was a debit on this side. Here, we're going to add it back to the amount that's lower. And then we should get the totals to equal again. I know it's kind of confusing, but the way to think about it is whichever is lower, the debit or the credit side, that is where you're going to add your net income. And then you should get totals to equal again. And this way we can see, based on this, now we know the amounts that are going to go into our statements, and we can double check our statements, or we can build our statements a lot easier because we already know what our revenues, what our expenses are, and what our net income is. And we can just go ahead and transfer all those amounts over to those statements and create those statements easily. And that's it for chapter 4. If you have any other questions or you'd like to discuss anything else, please let me know, and I would be more than happy to talk with you.